And kicking it off is rockstar number one, Susan Nickey of Hannon Armstrong. So if you want to join me on the stage, Susan.
Thank you, Janet. It's great to be here with everyone in the audience. Thanks for joining us live streaming. We're sorry we're not together in Denver, but this is the next best thing to it. I really couldn't be more excited to introduce our panel here today. We've really got the, as I said, all-star group of renewable energy financial executives, all veterans for more than 2 decades across the spectrum. And they'll be bringing to us really what's real-time insights into the market, covering the gamut of project finance, which we all care about, as well as the global flow of debt and equity that is so important and still coming into our sector to fuel our growth. With that, I'd like to make introductions. First is Esben Pederson. I'm not sure if he's on my left or right on the screen, but Esben is the CFO for Pattern Energy in Pattern Development. He's responsible for executing capital strategy and treasury for all of Pattern, as well as all the requisite CFO functions. He's been with Pattern since its inception for over 11 years. And they've built a phenomenal platform with over 4 gigawatts of renewable energy projects. And he also has had a most unusual, unique experience of successfully executing on taking Pattern through what they call a private takeout with the Canadian Pension Plan, one of those funds that's also very interested in our space in the midst of COVID. So on my next panelist was Martin Torres, who's the managing director, head of America for BlackRock's Renewable Energy Group. BlackRock is the world's largest asset manager. In his role, Martin is heavily involved in fundraising and currently right now, fundraising that's been in process for another $1.5 billion to $2.5 billion targeted fund for renewable energy investing globally. They successfully kicked off a first closing in December and continue to move forward on that path. Once they raise the money, Martin also has to make sure he helps invest it wisely with his team and the renewable energy platform, which BlackRock has continued to grow. So we look forward to his perspectives on that front. Then joining us is Steve Ryder, who is the Executive Vice President and CFO for Clearway Energy Group. Many of you maybe remember that Clearway Energy Group really came out of the NRG renewable background. They were acquired by GIP, Global Infrastructure Partners, about 2 years ago, not quite even 2 years ago, and renamed themselves Clearway Energy Group. Energy also was the Energy Yield Co. was also acquired by Clearway and goes by the name of Clearway Energy Inc. Steve has had a long history in renewables, was formerly a CFO at Invenergy, and then joined Clearway to build out their whole financial organization and lead the path forward. So he brings both the private side of that business and as well as oversight into the publicly traded affiliate. And then, of course, Ray Wood, who I think many of you know, sees it all, has seen it all, and just over a year ago was actually promoted as the managing director and co-head of natural resources. So he not only sees the global power and renewable energy activities, which he has led for years at Bank of America, Merrill Lynch, but took on the added responsibility and no doubt other special challenges of the whole natural resources group, which includes oil, natural gas, and as we know, natural gas and renewable energy markets are intertwined. So we look forward to raise global perspectives on that front. With that, I'd like to turn first to our panelists' reaction, how they've managed through what seems like an eternity, but really has only been almost a 3-month anniversary of COVID starting to close our offices, the unforgettable stock market crash, which was in late March, and some of the capital markets for bonds were closed for weeks, and lots of uncertainty on the private front. But yet they've all have a great stories to tell about how they've managed through as we start to see the markets emerge. So I'll start with Esben, since you executed on the CPP acquisition, the buyout.
Yeah, thanks, Susan. And I should just do a sound check. Can you hear me okay? I just want to make sure that my audio is okay. Well, if I think about the moments of closing our transaction, our merger, which happened really only 2 or 3 days after the initial crash in March, we had plans to go see investors, lenders, stakeholders. Obviously, all of that had to be put on hold, but those were the small things, right? The big things, in broad strokes, our business has really fared quite well through this crisis. We have the fundamentals of the renewable sector still remaining, strong. The renewable costs are still extremely low. The ESG trend for investing remains robust. Interest rate environment is probably modestly improved, at least as base rate goes. There's certainly constraints short-term in the capital markets, but overall, I think I see really good capital formation relating to the interest rate environment, and then technology continues to be good. So our business has really been only modestly affected. We've have projects in construction that have continued unimpeded. We have developments that we've had to carefully look at capital deployment, and we have been careful in thinking about shoring up liquidity in our business to make sure that we can weather what is a more uncertain environment. And so, I think by and large, I feel very good about where we sit. It's an unsettling environment for everyone, including the work from home. We were fortunate to have transitioned to a work from home environment ahead of this crisis. So most of that has actually gone quite well. And I would say we had a honeymoon period right after we went all home where it almost felt like productivity went up because, people were able to focus. But we're working off of years and years of inertia of knowing how to work together. And so that has been a huge help. But, I would say by and large, it feels very stable where we sit today.
Well, congratulations. Martin, you successfully had an initial close in December. Have the investor stopped the capital flow, or now that we're in June, the beginning of June, what's happened in the last 6 months?
Yeah, no, fortunately, we had a subsequent closing for our current fundraise at the end of March, early April. We expect to do the same over the course of the next few weeks as well, and keep that moving through the end of the year. Fortunately, and to some degree, it's a testament to kind of the bigger, broader organization. We have tremendous connectivity with our investor base and more broadly with the firm's clients. So, we've been able to continue to have fundraising, meetings, hold due diligence sessions, and we operate a global business within our team. Obviously, the firm is global in itself, but so we're able to pull our colleagues from Europe, from Asia, run diligence sessions for clients all around the world. So it's been going very well, all things considered. For sure, there's a meaningful difference between being able to sit down with a prospective investor who's going to commit capital to you for an extended number of years. For our existing clients from our prior funds, it's a much easier conversation. They know us. They've seen how we've performed. For new clients looking to commit substantial amounts of capital in this environment, it is a little bit more of a challenge. Fortunately, again, the sector broadly is doing quite well around the world, so we're able to sort of manage that and continue with good momentum. I would just sort of echo. I mean, in terms of our existing portfolio, which ranges from assets that we have operating, again, in many countries around the world, assets we have under construction, under late stage development. The actual impacts of the virus and related issues have been relatively minor, which I think is certainly, we're fortunate for that. I think, at least anecdotally, it seems like it was less impactful for most people in the market. But few construction delays, few force majeure notices, but nothing that's had a material impact on expected performance.
Well, that's going to be very reassuring to investors, and success breeds success, I hear from both of you. Steve, Clearway in some ways has a lot of, it has assets and a huge platform, but yet a fairly young, fresh platform too, with new folks. And you've got both the private equity group and investors and still public market affiliate. Is life different for you, or how different is it?
Yeah, I mean, there's a few different ways to approach that. I think as a general enterprise level, looking back, one of the fortuitous things as we moved from under ownership of NRG to GIP is that we, at the end of 2018, beginning of 2019, invested a lot in technology, particularly how we could work together mobily. And we didn't have a crystal ball, but that has been a very fortuitous investment in our transition under GIP's ownership as Clearway. So we've found the daily interactions of us within the company to be fairly minimal, really touching on what Esben was saying before. And I've quipped, well, maybe the other reason why we're pretty productive is because no one's able to take PTO, there's nowhere to go. So so everyone's fully engaged. But on the development side, one other general point I would say in terms of liquidity is the first thing that comes to mind when you're dealing with something like this and when you're experiencing this March. And so that was very much top of mind. But the situation that we were observing in late March versus where we found ourselves in May and June feel very different. And even during the headier times in March, there really didn't seem a time where the banks were just shut out of the market, not lending. They were cautious, and you also saw some perhaps elevation in pricing there, and things taking a longer time. But we didn't see a cessation there. On the development side, we've been able to close transactions. There's just been a deeper scrutiny on the larger supply chain that informs the project, and then on the operating side, where most of our assets are with CWEN, a lot of the assets are long-term contracts. So you're not really seeing the impact versus, say, a merchant gas plant or something like that. And the last thing I would say is that in terms of the operations, we've had to take modifications, not having two people in a truck, not having two people up in the hub or nacelle. But we've found that any productivity challenges related to that has been fairly minor. So all in, fairly minimal impact from COVID as we sit today.
Again, good news. Ray, I know you see all the capital markets, and at the same time, what's happening we had an oil crash and challenges in the natural gas market at the same time. Let you.
Yep. Yeah. Oh, certainly. Well, thank you, Susan. And look, I've added the panelists. It's worked remarkably well. The workforce is safe and dispersed. It's a relatively young workforce on the investment banking side, so many of them are living with their parents or at an offsite location. And the search for Wi-Fi was kind of the most pressing need they had in order to exist in this Zoom world and to interact remotely. That's all gone very well. So much so, I'd say that if you just look at it from a brute force work perspective, before we even turn to the markets, that everyone's busy, and as they kind of report the things they're working on and the amount of time they're spending on it, it's really about regular way from where we all were when we commuted into the office. So there hasn't really been any degradation or inefficiencies in that. What we've been working on and how we interact obviously has changed. The initial crisis, a lot of big corporations drew on their revolvers. So the money center banks were, we'd all struggled to grow our loan books over the prior 5 years, and we grew it more in a quarter than we'd ever seen. So kind of just under 20% growth. And so that it's not always the type of growth you want. The revolver draws, it's really meant as a backstop. But the vibrancy of first the investment grade bond market and increasingly the high yield and the B loan market, as well as the equity market, that liquidity has been noteworthy. And a lot of that balance sheet pressure that may have existed temporarily for the banks has receded. We all have to be cognizant of the volatility and what could happen with a similar downturn. But right now, the strength of these markets and the resiliency, I know we talk about grid resiliency, but the resiliency of the market through this pandemic has been noteworthy and a very positive fact. And you can see that in terms of secondary trading levels. Renewables as a microcosm has, performed kind of best in class across the energy sector. Even regulated utilities have traded down relative to the S&P 500 to their kind of commanding perch they were in the fourth quarter and the first part of the first quarter. And while many of the renewable companies had an abrupt decline in March, many of them have recovered. Most have recovered, and access to capital does not seem to be in doubt. The concerns about supply chain disruptions and about site limitations and the expiration of the safe harbor, some of those fears have then receded a bit. I mean, we have to be vigilant in that regard, but the extension has been very helpful. We see, because of the technology march that I think both Esben and Martin alluded to, we're seeing a lot more solar. So we have seen companies go out and raise kind of expensive holding company money to make sure they have enough in case things get worse. But by and large, regular way transactions are back within the typical bandwidth that we had pre-crisis. So we don't see a degradation in the cost of capital, and we see access is readily available. And we'll get into it throughout this panel. I would imagine that the interest to be in the space, to deploy capital for the long-lived assets, for the ESG and the impact remains very high. And so we're optimistic that we can continue to channel capital into areas that, to serve the growth.
Well, that's good news. Martin, would you echo Ray's comments, both in terms of your continued fundraising from, I think, probably a lot of ESG investors, as well as you raise capital for the projects in your platform at that asset level? In terms of access, I think you said, but also cost?
Yeah, I mean, it's interesting on the ESG point. I mean, we sort of kicked off the year in January institutionally with Larry's letter focusing on sustainability and ESG. So there was a real, sort of dialogue at the firm level with our clients really across the spectrum. Now, obviously, we've been in this business at the firm for the last 9 years, so it's nothing new for us, but it was a greater part of the dialogue with investors that weren't familiar with our business or hadn't been invested with us. So we really came into the crisis with a lot of that positive momentum, if you will, in terms of engaging with investors. And again, as I mentioned earlier, that has continued. I would say just in terms of the investment opportunity set, I would say we're cautiously optimistic as we look in the near and medium term about, the ability to deploy capital kind of within the range. I would say it's tougher for us to think about, marginal deals in this environment, because I don't think we need to. But we do. We also don't see, a wave of distress coming through the sector. So we just want to make sure that we're focused on doing the right kind of deals in the right places as we move, forward the next 3, 6, 9 months. But no, we've got a lot of capital to deploy, and we do see opportunity out there.
Right. Ray touched on the importance of the safe harbor ruling that came out last week to address that uncertainty. Steve and Esben, you both have huge pipelines in wind, and which is particularly benefited from that. How, I'll start with Steve first. How has that helped you, or projects and moving into next year to be able to, or have that possibility? How does that help you? And also, how do you deal with tax equity crossing over year ends if they tend to like annual pockets of their own capital commitment? And I'll let Esben answer the same.
Yeah. I mean, this obviously we're elated to hear that the administrative through Mnuchin channel and IRS was able to provide that window for the projects for an additional 5th year, where we didn't know whether that was going to come through that angle or through a legislative angle, but glad that prevailed. We actually, for one project, it's required us to be judicious in what we're doing. So we actually had one project where we thought we should put it on hold and wait to see how things turn out. And now we'll be revisiting that project with this. So in terms of additionality, we can definitely check that box there. In terms of another project that we have, we found that people on both the capital side as well as the equipment side were very thoughtful in thinking about how to look at the risk, how to structure the risks appropriately. So there was a lot of creativity and innovation that we saw that came from our industry in the absence of a safe harbor extension, which we found very gratifying. Now, all that structuring is for naught because we have the window, but it really gets to the point of having the relationships, which are really important here to help inculcate that type of creativity in the structure.
From pattern standpoint, I mean, maybe my first comment would be, I do think that the extension is a testament to how much support there is around renewable and finding, good solutions for real problems. And so I think it was certainly the right thing to do. And a huge congratulations to all of the teams, including AWEA, that was involved in getting all of that done. So, we think it's a win. It's a really good, change to the legislation allowing this extra year. I think the capital commitments can roll into next year. I think it does mean next year will look a little different, but it probably the bigger question is, what is tax capacity going to be for the institutions in 2021, and to what effect does the COVID and the earnings impact that comes from that really ultimately impact overall tax capacity next year? But from just the policy standpoint, I think it was a good thing. Our own projects were in construction were not directly impacted by this, but we did have development projects that certainly will be able to take advantage of this, and that we can go back and look at more closely for having this extra flexibility.
Well, that's great. It would certainly, from a capital markets perspective, be disastrous to get to the end of December and not be able to fund with the important tax equity as a stack. So Ray, the M&A market, we're hearing this positive backdrop, and the continued pipeline has been really frothy the last few years for renewables, not only for individual projects, but certainly, as we've got right here, exemplified in our panel here, platforms, pipelines, the works. Do you see that momentum being the same? Any adjustments? And sort of as related, given your perspective on the merchant markets and oil and gas, that plays a big role in valuations. And there's certainly been COVID demand destruction as well as other challenges in the sector.
No question. I mean, it's a bit of a tale of two tapes, two cities, if you will. There is heightened scrutiny on the merchant tail, and a lot of the volumes of projects that either had unknown counterparty risk, unknown being unproven, and we can go region by region if you want, and then those with a merchant piece and what the base assumption should be, given the demand destruction you mentioned, and just given the volatility on the gas front and whether the oil crisis or the plummeting oil was good for U.S. nat gas or bad, and there's a whole algorithm there. But I think in general, while people stood on the sidelines and didn't really want to try to auction projects in the beginning of this pandemic, I think, you know, we've got several things underway where we feel like where it may not be a full auction, but where you can get some price discovery and talk with some reliable counterparties and have a relatively efficient, shorter process to get there. I think where we're seeing is there's ample appetite at a high level, and then the devil's in the details. And so if the project if the portfolio is laden with merchant risk, basis risk, if they haven't arranged their tax equity, I mean, I'm not to be negative and pile on, but there are projects that are better suited to move efficiently in these markets than others. And so sponsors will kind of self-acknowledge that. And so the market is a little bit discerning, just as it always was, but that's the case here because the downside risk on the merchant has likely gone up a bit, just given, but in some respects. On another basis, you know, nat gas should benefit at some extent with associated gas production going down. And so all eyes, you mentioned, all eyes are on the demand curve and it's too early to know, but we've seen some somewhat disturbing signs in terms of demand recovery with reopenings that hasn't really materialized. And so again, it's too early to understand what's going on there. And again, shoulder month stuff isn't always as telling, but people are taking limited data and trying to draw conclusions. So there are some open issues there, but I would say the strategics and the list of players who have invested in the hard assets and are comfortable with the risk-adjusted returns, who are now pursuing to augment that by taking on more development risk or later stage development across the whole spectrum, that drumbeat of demand remains very high. And I think while you've already had wind development consolidate pretty dramatically, solar development is still more fragmented for a whole host of reasons. And so we do see kind of an M&A thesis on consolidation, and we continue to think that developers will reach out to that money, both to raise working capital, de-risk, and there are all kinds of structures to do that where they don't have to necessarily agree on value today. So yeah, we see a lot of activity. We're in the middle of some of it. We wish we're in the middle of more of it. But we're pretty upbeat about those trends and how visible some of that near-term deployment is.
So good. Well, I hear Ray has more capacity for being a banker on deals. Martin, your target new fund at $2.5 billion. You have to compete for assets, and I understand half of your oops, you got some noise in the background. Half of your fund is targeted for the U.S. Do you see yourself better off? And I'll note that you guys. Sorry for getting an echo. That certainly BlackRock has broad insights in not only in Martin's fund, but some of their other funds into the power markets, natural gas markets. So be interesting to see if you think you're better off for these opportunities or about the same.
Yeah, look, I mean, I think we're relatively well positioned, probably slightly better positioned than we were on a relative basis pre-crisis. I think that although there's a lot of investor appetite that we're seeing among our client base coming through our funds, I think some of the domestic or the international direct institutional investment is slowed down. It's a little bit more cautious. For those of us that have participated in these markets for years, you've had exposure to merchant markets, whether it's ERCOT or PJM. For years, we not that we have a crystal ball, and certainly not that we're perfect at forecasting, but sort of understand the dynamics a little bit better and sort of what to how to think about those markets. So again, I think we're better positioned on a relative basis than we were. I think that it's still largely a healthy market kind of across the board. So it's all relative. It's the extent to which I think we're better positioned is not as great as I'd probably like. But at the end of the day, I really like having a healthy market. So, there's certainly a trade-off there. But, I think that we're, as I mentioned earlier, sort of taking our time a little bit, trying to be cautious. And, despite the fact that we do have capital to put to work, we want to make sure we're not doing, deals at the margin, because I do believe that we will continue to be rewarded for relative patience over the next 3, 6, 9 months. I think that beyond that, my expectation would be the market kind of reverts back to what had been a very, very competitive place to be an investor, looking into 21 and into 22.
Good. Well, Steve, you mentioned that your portfolio is largely contracted, and I think possibly with a public company affiliate where you place a lot of your assets, like having long-term offtakes or offtakes of some sorts. With COVID impacting corporates who have been growing in that area, how does that impact how you underwrite these PPAs and think about them to have the financial stability and also have other investors in those projects be comfortable, including your affiliate?
Yeah, you're right. We do have a lot of our assets are contracted, and although I know this is an OEA event, we also have a significant community solar portfolio as well, which has a lot of C&I offtakes. So we've always been doing periodic reviews of our not just our C&I offtakers, but what is the issuer ratings that we have for our banks that we work with that are issuing LCs on behalf of our projects. So we've stepped up the frequency of that. Of the C&I portfolio that we have, still 95% are in investment grade territory. And then if you were to dig deeper into the qualitative aspects of those, a lot of the off-takers are supermarkets or telecom companies or universities that either have, which fortunately have not been too COVID impacted, but that's helped us to remain vigilant. We're still applying the same type of credit principles as we had in the past. But the other thing I would say is as we've been going through this, it's helped us to reflect more upon the asymmetry that can exist between credit support that we're providing in terms of developing projects and what off-takers are willing to provide. And it's and you start walking through and it starts to raise questions. And unfortunately, we're in a buyer's market for power where we don't have as much leverage as we would like to have. But we have seen situations where the credit, the ask for what they're willing to provide and what we are able to provide is so apart that in certain times we've walked away from projects because the credit support isn't there. So we made a recent decision on that. We feel good about it because we want to make sure that other than reputational risk, there's something for the off-takers that we sign up to have some skin in the game, if you will.
Yeah, I'd say, Esben, have you had to change or turn any corporate buyers down that are being impacted by COVID, or is it too early to tell?
I think this is a really important topic that I don't think we have full visibility into kind of how this is all going to play out. But there's a couple of things I would mention. The first is, as the crisis hit, we and I'm sure others did, really had to ramp up our scrutiny of all of the existing arrangements, make sure that we were clear on credit exposure as a result of that event risk. And I think when you step back from all of that, I mean, this is anything from looking at bank capacity to counterparties' ability to pay to, should we enter into new capital commitments when we don't know whether we have a PPA counterparty who will actually sign up for the deal. So all of that had to, we simply had to set up a task force to deal with those issues, in the very, very short term. I think that has come about relatively unabated. I think there hasn't been a huge impact yet, but I also don't see that the real economy has yet caught up with some of the things that are happening. And we all know that when we underwrite these revenue opportunities, you take a combination of regulatory risk, counterparty credit risk, or merchant price risk, and they start to, especially regulatory risk and credit risk, they do start to converge in some jurisdictions where budget pressures, other things, does become something to pay a lot of attention to. And so as I look out, that's one of my bigger concerns. Corporate PPAs, you got to be really thoughtful about the credit that you're walking into. But even on some of the old bus bar PPAs that you own or buying into, I think you have to be really thoughtful about sort of what's the regulatory and credit risk that you're taking there. So we've been signing PPAs, frankly, in this time on the basis of having looked at those factors.
Great, because I know the corporates have certainly been a huge growth factor for our renewable energy industry. So as we look into the next half of the year, and everyone will be out fundraising for 2021 projects, let's touch on the different parts of the capital stack. And I know there have been a number of panels on tax equity, but clearly that's a key part of the capital stack. And I know, Ray, your bank is one of the significant players, and you're all probably looking for tax equity now. Maybe just get a quick uptake on that.
Yeah. So look, it's a great question, and we've talked about liquidity in the market and how surprisingly robust everything is. I think because of all these other uncertainties and the knock-on impacts or the longer-term impact the COVID break has caused, tax equity probably is a bit of a pinch point on the renewable side, and less so for wind, because with the 10-year PTC, and the 5-year makers, you could look through a recession in bank earnings and still structure your way into some deferral, and the pricing impact of deferral would not be as problematic as it would be for solar and the ITC. So the way the ITC, the way that solar is subsidized with the ITC does pose problems. And we're spending an awful lot of time assessing where the demand is, looking at projects. We get a sense that there aren't that many players out there because we are getting several inbounds, and the way we need to commit 6 months before, and you talk about counterparty risk, and you talk about trying to be more efficient, Esben, and we look at, well, how long do we want to have exposure open before we fund, and then we fund an ITC deal, and the next day we fund a solar deal, and the next day we get 80% of our money back, and yet we committed. So we're all kind of have to find the new equilibrium on how those deals ought to be structured and priced. And we'd love to do more, and I think we see some of our peers have stepped back from the market because of uncertainties, whether it's their credit card business, whether it's other loan losses or whether it's the notion that they want to pay more in taxes right now from a policy perspective. So we are seeing some people step away from the market. So look, I don't have answers for you. We're actively engaged with clients. We'd love to deploy more tax equity capital for the right relationships and in the construct of the right overall kind of things we could do with clients. But it does feel pretty tight right now.
Well, I think our panelists are both in the wind and solar business in a big way, and are going to be concerned about tax capacity, I think, across the spectrum. Esben, Steve, are you into the market for 2021 yet that you can comment on? Is it too early to tell? I know there's push to try and expand the market in a couple different ways now that we're through the safe harbor issue.
Yeah, I mean, maybe I'll give you this perspective, which is, if I look at the total capital stack, tax equity makes up, 20 to 25% of the capital that we raise. It is an important component. It is a pinch point, frankly, in raising capital, and it's central to, a lot of it becomes 100% of a lot of the U.S. deals. or 50% or so. But it is an important component, but it isn't going to, at the end of the day, drive the overall ability to raise and fund these investments. The other components, the other 75%, are very, very healthy and are, relatively open. And I would say with index rates coming down as far as they have, margins haven't actually gone up to fully offset that. So I think you can still raise attractive debt. The equity rates are still, driven by ESG trends, driven by general attractiveness into the space of long-lived assets. So I feel pretty good about the ability to raise efficient capital for these projects. And on the tax equity side, I think that good projects, at the end of the day, they will be funded. And maybe we're sitting amongst a group of folks who do have an ability to put their projects forward. But, even within our own confines, we do have to think carefully about, on the margin, some of these projects, when they have a little bit more risk, you got to be more careful about whether you think you can get it. And I think that goes in terms of size of commitment, but it also goes in terms of risk of commitment. So big commitments, big risk, or small commitments, even if with low risk, that's sort of the harder part of the capital to kind of attract in efficiently. That'd be my perspective.
That's fine. We have a question from the audience, so I'll let Steve answer generally his perspective, but also comment. And the question is, we has been advocating to make the PTC, ITC available through direct payment. Given the tightness in the tax equity market, would direct pay or a similar monetization mechanism be required to continue to support robust renewable development?
Yeah. Well, I think Esben had said that tax equity is a constraint, but it's always been a constraint since the PTC has been in place since 1992. And despite one that you might see like a Facebook deal or efforts of some of the larger people in the market to bring others behind them, it's always been the scarcest part of the capital stack. And in terms of pricing, I would say that if you have a riskier project, you're not able to get that done necessarily with tax equity by just increasing the rate 100 basis points. The tax equity would much rather be in a place to make sure that the risks are properly mitigated. And if they're taking a slightly lower rate there, it's a much more comfortable place where in the greed versus fear alignment there for capital providers. In terms of the direct pay, that is, I believe, getting some traction here. Obviously, given how people feel about refundability of those natures, it's something that people try to approach very carefully in DC there and make sure that they're the last time we had something akin to that was back in the 1603 days under the ARRA, and I think people want to make sure that if there's some policy being put forth, that it's modest in nature and that it considers some of the history in the right appropriate way on what makes for good policy.
Great. Let's see. Also touching on other parts of the capital stack, maybe. You've y'all access different parts of that, but Ray, last year there was, I think, some nice positive trends in private placement bonds, 20-year bonds that even had merchant tails that were rated investment grade. So we saw appetite from the debt institutional investors, as well as the banks. As you're advising your clients today on, depending on what access they have at the project level or corporate level, do you say, just talk to the banks, or now's a great time to continue to talk to insurance companies? I know we have green bond issuers on our panel.
It's a very liquid time. I'd say all of the above. I don't want to appear glib, any more glib than I always do. But I would say that there is some of it, so you have to consider a couple things, how long you want to hold the project and whether you want the duration or whether and you want that amortizing or you've got a corporate structure where you want to have more of a bullet structure and you want, you're not necessarily maximizing an IRR and risk-adjusted equity, but you're providing more flexibility and using the deferral of principal amortization to fund other growth, a la the YieldCo model. And then you've also got some private equity investors, be they insurance companies on the equity front, as well as sovereign wealth funds or other institutional players who may not want more encumbrances on the project, who'd rather back leverage on their own. So I'm not trying to evade your question, but there's it's pretty easy math to go out and tackle the market you think is best. But what's best is really going to be a function of the corporate objectives. And yes, the term market is there in the non-banks. The bank market is also there in size. And so I think all of the above is the approach. So I don't think you need to go to, and you don't really even need to play the markets off each other. I think they're pretty resilient in their own right. So it's one thing, people don't want to waste time. So if they feel like you've just got a bunch of free options and you want them to do all this work and there's no commitment, that can work in the short term. But in the long term, I think you have to lay your cards on the table a little bit. That's not only a COVID comment, but that's just given how busy people are. So, but I do think, yes, the bond market is great. The insurance company sophistication on this has always been there, and it's really there in size now. And we see some companies that want to own all of it. They want the senior debt, they want the sub debt, they want mezz, and they even want some preferred project equity. So we're getting kind of unitranches that represent strips of the entire capital stack, and that defrays a lot of the capital costs for the sponsor. But it also means the sponsor is behind a considerable amount of leverage, if you will, or preference. And so that can up your returns, but given the commentary about merchant and counterparty risk, it can also increase the volatility of the return expectations for your own investment.
So Martin, how does, following up from Ray, how does your group with, I think you raised from sovereigns and all the different institutional investors Ray mentioned, how do you like to raise debt or think about debt for your fund? And then certainly BlackRock has funds that invest in all parts of the capital stack, but I don't know that you can work together with them.
Yeah, I mean, historically, we've been working with third-party lenders, and whether that's sort of banks or institutional lenders, but not with our sister business that focuses on infrastructure debt. I would say, as others have commented, we've continued to see tremendous depth at very reasonable levels in the debt markets. We've financed projects, over the course of the last couple of months. We've taken new projects. So, it's sort of one thing to talk about projects that you had under consideration and folks have been working on for a long time, and then you get to March and they close 2 weeks into the crisis. But we've actually started conversations in March and executed in May. So, really seeing the resiliency of the market. Now, just in terms of, and Ray was sort of touching on this point, I mean, we do see a lot of depth at all levels of the capital structure. If we were looking to, sort of pull in, capital at many different levels, subordinate or senior to us, typically our investors are looking for some measure of consistent cash flow as part of the overall return. I mean, that is part of our investment thesis. So, we limit ourselves just in terms of how much leverage, we want to put into the portfolio. Now, for any given asset, it may be a different story. There may be reasons why it makes sense to finance one project a certain way relative to another. But as we think about the portfolio overall, we are trying to maintain some consistent, cash distributions that we can flow through to our investors on a real-time basis.
Great. Well, I'm going to pivot it because we have a few more minutes left, and all of you have been your companies are members of OEA, and in fact, board members. Ray was most recently the treasurer and a longtime board member before he handed the torch to me about a year ago. And then you're in this for the long term. We're talking about tax equity constraints, tax equity step downs in any case. Would you all care to comment on what you see as an effective public policy mechanism going forward to continue to bring in the capital and more low-cost capital to grow renewables? I guess I should, maybe I'll start with Esben.
I think
Mike's listening in.
the policies that I really ultimately what they need to address are a couple of things that are important as we look forward. I think regulatory certainty and a clear path for investing is part and parcel with being able to put development capital at risk to, underwrite revenue propositions in the long term. And so I would say by and large, the stability of that is one of the more important things. As I look at the current environment, I will comment that the X factor that I see is really around the federal election outcome, and that could spring open opportunities, or it could narrow the opportunity set. I do take a lot of comfort in our ability to produce and create really competitive products. And so I am more worried about making sure that we support the solar and the dynamics between solar and wind and renewable overall, as opposed to creating a wedge between us and other sectors, because I do think we have a competitive product. We need stability and regulation. We need, obviously, climate change addressed, and that's our perspective as a company. And I think there is an underlying desire to do that, broadly speaking. And so, but if that can be done, not in a year by year type of approach, I think we'll get to a much better investment environment.
Yeah, we're talking about assets that have 30, 40-year lives. Steve, Clearway's also has a strong mission and advocacy.
Yeah, and we'll continue that. We're very engaged with the industry groups, and that's been very important to us, not just at the federal level, but other at the state and local level as well, which is really important for other parts of our business that aren't necessarily in wind. Yeah, I mean, there's I agree with Esben's point here that there's a lot is going to hinge on who's sitting in the White House, who's sitting in Congress. This is probably all in the rearview mirror, just in memory, but not too long ago we had the Clean Power Plan, right? And which people were trying to digest and figure out how is this going to affect. I think people understood directionally, but in more detail how it was going to affect renewables. So I think that given changes there, it could be those are going to be important exogenous factors on how we think about the renewables business and moving forward.
Ray, what do you see? What do the capital markets need?
Well, look, I mean, I think it's a complicated question. Certainly pricing carbon would be the most efficient way of facilitating capital mobility. And we've had a tradition of doing this through the tax code, which may or may not continue. The other element here, the technology disruption is evident across many traditional industries. It's obviously evident here in power and in energy. And we see that technology disruption accelerating. So while the tax credits are very important, that ability to bring new things to market, both behind the meter and on utility scale, and how that all now merges in with storage and other intermittency issues. It's amazing how much progress we've made, notwithstanding kind of a hostile administration to the fundamentals. And so I continue to be very bullish on those opportunities. We're seeing an awful lot of time being spent in the C&I space, not only with solar, but with other solutions that can save money against a utility bill and can avoid a fair amount of utility transmission spend and can help debottleneck certain things. And we also see some catalytic technologies on the wholesale side. So, you have right how we motivate renewables, whether that's the tax code or carbon price, but how are we going to handle supply chains and what regulations are we going to have that globally impact manufacturing, and how quickly can we pivot and have more manufacturing here, and at what cost, and who's going to bear that cost, and how will all that impact returns? I mean, there are a lot of complicated issues in your very straightforward question.
That's a good wrap up for Martin, and also BlackRock is the world's largest asset manager. There's a lot of capital being run through your organization.
Yeah, I mean, I would say, and it's certainly nothing new. You know, there's been a lot of capital that's been interested in investing into the space for quite some time now. I think that, you know, what was already mentioned, regulatory uncertainty, you know, has you know, in some ways it's created structural barriers where you know, some capital that would be available and interested in investing, you know, can't take advantage of the tax credits, sort of most simply here in the U.S. And so that creates a barrier to more capital coming into the space that probably would. But I think even as we're seeing at FERC currently, you know, thinking about solar in particular, the fight around net metering, state versus federal. You know, I think there are a lot of areas where it's not so much a function of a subsidization question, but rather, you know, just making sure that the policy framework works, it's understood, so that people can make investment decisions and sort of, you know, create those long-term plans and then ultimately execute upon those. So I think it's, you know, it's in part making sure that you know, certainly everybody in the industry, but a lot of the dialogue that we spark is focused on sort of the right issues that are going to, you know, sort of further enable incremental investment over time. It's always difficult, you know, to sort of think a little bit medium, longer term when you've got near-term fires that require fighting. But sometimes I think, you know, sort of that's necessary to really lay that groundwork and see kind of a solid investment landscape as we move into the next year and the year after that.
Well, that's great. Well, we could continue on, but our time is wrapping up. I would like to share that as we think about policy for the next long term, that our audience survey showed that 80% of the audience believes that we'll have a carbon policy or carbon price within the next 10 years. And so I think Jana has a question to wrap up, but I do, again, want to thank our panel for taking the time to share their insights and away from their busy schedules. Esben Pederson, Steve Ryder, Ray Wood, and Martin Torres. Thank you very much. And I'll close and turn it back over to Jana. Okay. Thank you.
Great job. Thank you so much, Susan, and thank you to the rest of our panelists. That was great. And just to ease any minds, the Dow is still up almost 400 points, so I think they must like what you're saying. In all seriousness, that was a really informative panel for our audience, and we appreciate it. We know a lot of folks were able to listen live. We do have it recorded, which we will share with the rest of the membership, so everyone will have an opportunity to hear your important remarks. This is, we're right at the end of our program, and it has been a delight to be with all of you here today. It has, it's not the same as being there in person. We're ready for next year, and just wanted to get back to the poll that we opened this all up with. So what do you miss most about being in person at CleanPower? Not surprisingly, it is the in-person business meetings. That's why we do it. We want to have an event where you all gather and you get business done. We are excited to have that event live again next year in Indianapolis. We think it's going to be exciting. I did want to give a little bit of a sneak preview. You're going to see a video in a few minutes, but one of my favorite events at in-person CleanPower is the opening reception. And I don't know what you all think about Indianapolis. When you hear that city, what do you think of? I think of fast cars. And so just maybe something for you to think about it. If you like fast cars, you might want to come to the opening reception next year. It's going to be a lot of fun. We do have one more event that you all can participate in. As I said yesterday, we are committed to our communities. We are committed to doing things that serve others. This year, our service project is a blood drive. Please take time to go to your local Red Cross and donate blood. There's been some severe shortages as a result of the COVID pandemic. There's some information on the screen right now. We will be getting this out to you via email as well. We hope you can support that effort. It's really important for our country right now. I wanted to now bring Tom Kiernan, CEO of the American Wind Energy Association, back to the stage, who is going to officially close us out. But as your moderator the past couple of days, your MC, it has been my pleasure to be here. And welcome, Tom, and thank you for being here to close out this important session.
Great. Thank you very much, Jana. Thanks to you and your team at AWEA for pulling this all together. We really appreciate your leadership and your team's hard work. And I very, very much want to thank everybody for joining us at Clean Power 2020 remotely. This has, from my view, been a really helpful and informative set of panels and discussions. Again, unfortunately, we're not able to be in person having the business meetings that were just alluded to in the survey, but really appreciate your involvement. Look forward to welcoming you to Indianapolis next year. Also want to say we will be having all of our conferences as scheduled this coming fall, whether it's offshore, siting, O&M, et cetera. Now, we're still trying to figure out, they will be online. We're hoping we will be able to have them in person as well. So stay tuned, but very much keep them on your calendar. So with that, thank you very much for joining us at our first Clean Power. I hope it was helpful and successful for you, and look forward to continuing our great work together in clean energy going forward. Thank you all for joining us, and take care.